Jonah, where do we go from here on on the politics of bank regulation? Because again, if we can, the three of us agree that what caused this was neither wokeism nor a bank regulation failure, then how do we actually prevent this from happening again?
Well, look, there's an argument that it should happen again in the sense that there need to be consequences for bad policies, both in the private sector and the public sector. I do want to sort of push back on a couple things that you hear all over the place. So, and then I'll explain my point. First of all, I constantly hear people, including friends of mine, on TV, on Twitter, in the urinal next to mine, saying how the moral hazard here is huge because now banks are going to take even riskier, make even riskier moves, knowing that everything's going to be backed up. Well, that argument would be very persuasive to me if, in fact, the Silicon Valley Bank were being bailed out. It is not being bailed out. Everyone's losing their jobs. Their bonuses, which they probably should not have gotten, were put into their accounts at the Silicon Valley Bank, and they're going to be clawed back. There is not a banker out there there's not a banker out there who looks at what's happened to the Silicon Valley Bank in the last 10 days and says, gosh, I can get away with that too now. Right. I mean, like there's a lesson for management out there not to make these mistakes. And so like bailing out depositors is different than bailing out a bank. And you can have arguments what the moral hazards are there, but a lot of people use them interchangeably.
Can I, real quick on that, do you think that any president, Republican, Democrat, you can use specific presidents, however you want to take it, do either of you think any president would have done anything differently? Big picture. I don't mean how fast he did it or some of the statements that went out. Would any president have not made the depositors whole by Monday morning?
I think not. I think the means might have been different. There's this semaphore story about how the Biden administration really locked out the big banks to bid on this thing, which is bonkers town if true. But yeah, I think at the end of the day, I mean, everyone, including I think the Biden administration, would have rather have done this a different way. But at the end of the day, I think they would have ended up where they are in terms of the fact that depositors would be made whole. So to actually answer the question that you asked before, I think there are some really good partisan arguments about that one can level at the Biden administration about why this mess happened. They just aren't the woke thing. Because first of all, if you think the woke thing is dispositive, show me a comparable bank that isn't putting money into ESG and marketing its diversity and DEI stuff. I mean, they are all doing that. The idea that like this was uniquely about wokeness, I just don't find persuasive. But what this was uniquely about was inflation and high interest rates. And there's a very strong argument, we've all heard it because it happens to be true, that the Biden administration deserves a considerable amount of blame for high inflation, which in turn requires the Fed to raise interest rates very quickly. And there's a phrase that I'm going to butcher that is very common on Wall Street that basically is about how when everyone looks great when interest rates are low, and then when interest rates are go high and the tide goes out, you see who didn't have swimming suits and who did. And so there are going to be more institutions. We're seeing it with Credit Suisse. There are real consequences, not just the family pocketbook things. There are real consequences to an economy when you have high inflation, because the checks and balance against high inflation is raising interest rates. And but for high interest rates, this would not have happened.
But for the speed at which the interest rates were made higher.
Correct. That's right. That's
if
fair.
It had happened more slowly, they would have been selling off the T-bills at normal pace, and it would have been fine.
That's right. No, that's absolutely fair, and that's right, because they just didn't have time. Which raises another point
which
about
is why this hasn't really happened in the past, because this inflationary period was severe, and the interest rate rise was so quick.
Right, but this does raise another point, which you often hear from the sort of MMT crowd, modern monetary theory, modern magical thinking, which they say, look, the Fed raised interest rates a quarter of a basis point and nothing happened. So all you're worrying about high interest rates being a problem, and that's not how it works. It actually takes time because there's these short, medium, and long-term contracts and durations for various treasuries and whatnot. And when they expire, that's when the high interest can nail you. And so it's an unfolding thing. So anyway, I think that it's very clear that Silicon Valley Bank had some bad policies. I read somewhere that they only had one person on their board who actually had serious experience in finance. And I think he's the one who worked for Lehman Brothers, which if I were that guy, I'd say, okay, now I'm going to open a sandwich shop. We need a serious rethinking about banking policy and all this. And all the people who say it should have been obvious to depositors and they should have known the risks. That's an argument for saying we should just have 3 or 4 too big to fail massive banking institutions in this country, which I don't think is the answer anybody wants either.